Welcome back to the Deep Dive. It is Tuesday, January 20th, 2026. And if you're listening to this in real time, you definitely know the vibe right now.
Oh, yeah.
The holidays are, firmly in the rearview mirror. The Christmas tree is hopefully back in the attic.
Unless you're one of those neighbors. We all know one.
We all know one. And the gyms are starting to clear out as those very ambitious New Year's resolutions start to fade a little bit. It's that time of year when reality just sents back in.
It's the back to business month.
Yeah.
And, nowhere is that reality check hitting harder than in the real estate market.
Absolutely. I have been spending, I'd say, the last 24 hours with a highlighter and just a massive stack of paper on my desk. We're looking at the full Q4 2025 data package from Peet Realty. We've got the trends reports, the market watch summaries, all the detailed MLS breakdowns. And I have to say, looking at these numbers, 2026 is waking up with a bit of a hangover.
That's a very polite way of putting it.
Yeah.
I mean, we're looking at a landscape that is just fundamentally different from what we saw 2, maybe 3 years ago.
Right.
The party is definitely over.
So here's our mission for today. We're going to decode exactly what is happening in the housing market. We have data for the entire Dallas Metroplex, and we'll touch on some of the neighbors for context, but our spotlight today is firmly fixed on Denton County.
And for a very good reason. Denton County has, arguably become the bellwether for the entire North Texas region right now.
The bellwether? How so?
Well, it sits right in that sweet spot between the urban core and the rural expanse. So if you want to know which way the wind is blowing for the suburbs, you look at Denton. It really represents that shift from the frenetic, overheated market of the early 2020s to, well, something else entirely.
Something else is right. I was skimming the headline stats before we hit record, and there are numbers in here that, quite frankly, they look scary on paper.
They do.
We're seeing significant price corrections. But before we spiral into panic or, excitement, depending on if you're buying or selling, we need to introduce the guide behind all this data.
Right. These reports come from the Peet Realty Market Authority, and that's David Peet. He's a broker with, I think, over 10 years of experience now, helping clients buy and sell specifically in these counties.
Yeah.
And that experience is crucial because as we dig into this, we're going to see that raw data can be pretty misleading without context.
Yeah.
You need someone who has seen this cycle turn before.
Exactly. It's not just about reading a spreadsheet. It's about knowing what it feels like on the street. And speaking of reading the data, we're going to be throwing around an acronym a lot today, NTRACIS. For anyone not in the industry, that stands for the North Texas Real Estate Information Systems.
But if you want to sound like an insider, you pronounce it net rice.
Net rice.
Like a snake's hiss at the end. Net rice.
Net rice. Got it. Okay, let's unpack this. I want to start with the number that made me spill my coffee this morning. The headline for Q4 2025.
The big one.
The median sales price in Denton County has dropped to $428,000. That is an 8.9% decrease compared to the previous year.
Nearly 9%. Let's just sit with that for a moment.
That feels huge. Usually when we talk real estate, we're so used to seeing up the 3%, up 5%, maybe flat. See a minus sign followed by almost double digits. That feels violent.
It's significant. An 8.9% drop is not a rounding error. To put that in perspective, if you own the median home, we're talking about roughly $40,000, maybe $45,000 of equity that has just evaporated from the valuation compared to late 2024.
Wow.
That's a luxury card. That's a year of private college tuition. Gone.
See, that's exactly where my brain goes. If I bought a house in 2024 and I look at this report, I am freaking out. I'm thinking crash. Are we looking at 2008 again? Is the sky falling?
That's the question David Peet gets every single day, and it's the most important distinction we need to make today. This looks much more like a correction than a crash.
Okay, you say that, but to my wallet, a loss is a loss. What is the actual, practical difference?
It really comes down to volume and motivation. A crash like 2008 implies a systemic failure. Financing dries up, people lose their jobs, and they're forced to sell.
Right.
That leads to this flood of inventory that nobody can buy, and prices just free fall into the basement. But look at the sales volume in the report. Closed sales for Q4 were 3,247.
Okay, yeah, I see that. It says it's down 2.1%.
Right, it's down, but only slightly.
Right.
3,247 transactions still happened. That means over 3,000 people still bought a house in Denton County in the last 3 months.
So people are still buying.
Exactly. In a crash, that number would be decimated. Life events are still happening. People are getting married, having kids, getting divorced, getting transferred. The desire to move hasn't vanished. The market is still functioning.
Right.
But the price that buyers are willing or maybe able to pay has adjusted downward. The frenzy, the speculation, that's what has evaporated.
So it's not that the market is broken, it's just that the price tag was wrong for a while.
Precisely. The market is repricing the asset class. We're coming off a period of, historical anomaly, that pandemic race for space.
Yeah.
And we're just returning to reality.
Okay.
And honestly, Denton isn't even the worst off. If we look at the neighbors, just to contextualize this, Collin County is actually taking a harder hit.
Really? I always think of Collin as that invincible, high-end market.
Their median price is down 11.2% to $430,000.
Wow. 11%.
It's almost at parity with Denton now. The northern suburbs, places like Frisco, Prosper, Celina, that saw that explosive, really speculative growth, are now seeing the most significant cooling.
The higher you climb, the harder you fall.
In this cycle, yes.
Yeah.
Meanwhile, Dallas County is only down 1.7%.
Oh, that's it.
So the core city is stable. It's the exurbs that are correcting.
Okay, so let's talk about the metric that I think affects the feeling of the market more than anything else. Because unless you're refinancing, you don't check your home value every single day. But if you are trying to sell, you feel every hour that ticks by. I'm talking about time.
The days on market, or DOM. This is the critical metric for leverage. In Denton County, for Q4 2025, the DOM jumped to 69 days.
69 days.
That's a 21.1% increase.
69 days. I mean, that's over 2 months.
It is a lifetime in real estate years. Think about the psychology of that. In 2021 or 2022, you'd put a sign in the yard on a Thursday.
And you'd have multiple offers by Sunday night. You felt like a genius.
Absolutely. Now, you put the sign in the yard on November 1st. Thanksgiving comes and goes. You're still showing the house. You have to keep the decorations minimal. You've got to hide the toaster every morning.
Oh, it's a nightmare.
Christmas comes and goes. New Year's hits. And statistically, you are just now maybe getting a contract in late January.
That is exhausting. It's intrusive. And that exhaustion, I imagine, shifts the power dynamic completely.
Completely. When a home sits for 70 days, the seller loses their swagger. They start to wonder, is something wrong with my house? Something wrong with the price?
And the buyer smells blood in the water.
They certainly smell opportunity. When a house has been sitting for 2 months, the buyer has time to think. They have time to breathe.
Right.
They can view the property a second time. They can bring a contractor out to look at the roof. And crucially, they have the confidence to negotiate.
It's no longer a sprint to the closing table.
No, it's a slow waltz. And this increase in time directly correlates with the inventory levels we are seeing. The report shows we are now sitting at a 3.4 months supply of inventory.
Okay, so 3.4 months.
Which is up nearly 10%.
I always get tripped up on months supply. For the listener who isn't a realtor, can we break that down? It always sounds like jargon to me.
Sure. Think of it like a grocery store. If no new milk trucks arrived starting today, how long would it take to sell every single carton of milk currently on the shelf? That's your month's supply.
Got it.
In real estate, a balanced market, where neither the buyer nor the seller has a distinct advantage, is usually considered to be between 4 and 6 months.
And we are at 3.4.
So we are inching very, very close to that balanced territory. We're moving rapidly away from the extreme seller's market we've seen for the past few years. The report shows there are 4,066 active listings in Denton County right now.
4,000 listings. That is a lot of competition.
It is. If you're a seller, you are not the only game in town. You are one of 4,000 options. Imagine walking down the cereal aisle and seeing 4,000 different boxes. How do you possibly stand out?
Right.
That requires a completely different strategy, which I'm sure David Peet emphasizes with his clients. You can't just stick a sign in the yard and wait for the offers to roll in anymore.
It's a beauty contest now.
It's a beauty contest and a price war, all wrapped in one.
Let's zoom in a bit then. We've been talking about Denton County as this one big monolithic block. But as we know, real estate is hyper-local. Averages can be liars.
They often are.
If I'm living in Louisville, my reality might be totally different than someone in a gated community in Flower Mound.
Absolutely.
Yeah.
And that's why these Peet Realty Market Authority reports are so valuable. They break it all down city by city.
Yeah.
And there's some really fascinating divergences happening right now.
Like what?
Let's look at the city of Denton itself, the county seat.
I saw this in the notes and I had to double check it. It feels counterintuitive. While the county as a whole saw a sales dip, the city of Denton actually saw a surge in closed sales.
A significant surge.
Yeah.
In December 2025, There were 129 closed sales in the city of Denton. Compare that to December of 2024 when there were only 88.
Wow.
That is a massive jump in activity.
That bucks the trend completely. So why? Why is everyone flocking to Denton proper when the rest of the county is slowing down?
I can tell you in 2 words. Price point.
Ah.
Look at the median price in the city of Denton for December. It was $380,000.
Okay, right. Compare that to the countywide median of $428,000.
Exactly. You're looking at nearly a $50,000 discount to live in the city compared to the county average. In an economy where, inflation is still a recent memory and interest rates are a reality, that 50 grand is the difference between being house poor and being comfortable.
So the correction isn't hitting everyone equally. The affordable stuff is actually flying off the shelves.
It's the hot segment. We're seeing a flight to affordability. Buyers are becoming very, very pragmatic. They're trading square footage or prestige zip codes for a mortgage payment they can actually stomach.
Okay.
And we see the same story playing out in Louisville.
Louisville has historically been that budget-friendly option for commuters.
And the data supports that it's still working. The median price there for December 2025 was $375,000.
Even a little lower than Denton.
Even a tick lower. They had 57 closed sales, which is up from 51 last year. But here's the kicker. Look at the days on market for Louisville.
Let me find that. Okay, Louisville DOM is 49 days.
49. Compare that to the county average of 69.
That is huge. That's a 3-week difference.
It tells you everything you need to know about demand. If you list a home for $375,000 in Louisville, you are selling 3 weeks faster than the guy listing for $430,000 in the suburbs.
So the market is screaming, we want homes under $400,000.
It is. It's like there's a psychological barrier in $400,000. Above that, the air gets pretty thin.
So what happens when you're right on that line?
Well, look at Little Elm. Things are softening there. Sales dropped to 39 units compared to 46 last year. Their median price is $429,500.
So they're sitting right at that county average.
And they are feeling the county average pain. 73 days on market in Little Elm.
Even slower.
It's slower. It's a tougher sell because you're competing with that massive block of inventory that's neither luxury nor bargain. It's sort of the messy middle.
And what about the high end? We mentioned Collin County getting hammered. Is the luxury market in Denton County just freezing up?
It appears to be hibernating. I look at the Flower Mound data, which is traditionally a higher-end custom home market. And there was an incredibly telling stat regarding land sales.
Okay, what was it?
0.
0.
In December 2025, there were 0 closed land sales in Flower Mound.
Not one lot, not a single one.
Not one. Now, obviously, land is a niche market, but land is also a canary in the coal mine. Land sales are a leading indicator for custom builds and luxury speculation.
Right.
When builders stop buying land and when wealthy individuals stop buying lots to build their dream homes, it tells you that confidence at the very top of the market is low.
It's risk off. Nobody wants to be the guy holding a $1.5 million spec home right now.
Exactly. But there is an interesting pivot happening in some of those high-value areas.
Yeah.
Let's look at Frisco, specifically the Denton County portion.
Okay.
We're seeing a divergence between single-family detached homes and townhomes.
Oh, the townhome market. I feel like that's becoming such a bigger part of the conversation as land just gets more and more expensive.
It is. In Frisco, the median price for a townhome in December came in at $474,990. That sector is holding its value relatively well.
Almost $500,000 for a townhome still sounds steep, though.
It does, until you look at the single-family home next door selling for $800,000.
Ah, okay. Context.
And suggests that buyers who want the premium VIP code, the Frisco schools, the amenities, the address, they're making a lifestyle trade. They're sacrificing the big backyard and the 4-car garage to get into the location at a price point that doesn't completely ruin them.
So the American dream is shrinking a little bit, square footage-wise, just to preserve the location aspect of it?
Precisely. It's density over acreage. That seems to be the compromise for 2026.
Okay, here is where it gets really interesting for me. We talked about how homes are sitting on the market for 69 days, or even longer in places like Little Elm.
Mm-hmm.
If I'm a seller and I need to move, maybe I've already bought the new place or I have to relocate for a job, and I just can't sell, what do I do?
You enter the world of the accidental landlord.
Accidental landlord. I love that term. It sounds like a bad reality TV show.
It's a very common reality right now. And honestly, looking at the leasing data in these Peet Realty reports, This might be the safety valve that's keeping the whole market from actually crashing.
Explain that. How does me renting out my house save the market?
Well, think about the alternative. In 2008, if you couldn't sell, what did you do? You just walked away. You foreclosed.
Right.
That dumped a distressed asset onto the market for pennies on the dollar, which then dragged down the value of every other house on the street.
It was a death spiral.
But today, homeowners have options. Let's look at the leasing activity. In the city of Denton alone, 46 leases were signed in December. The median price, $2,100 a month.
$2,100. That's a solid chunk of change.
It is. In Louisville, 19 leases signed at a median of $2,298. In Little Elm, 30 leases at $2,300.
So if you bought your house, say, 5 years ago, your mortgage is probably way less than $2,300.
Exactly. You're likely cash flow positive. Even if you bought 2 years ago, you might be breaking even. But the point is, the rental income allows you to hold the asset.
Okay.
You don't have to fire sale it. You don't have to foreclose. You just put a tenant in it and wait for the market to recover.
It creates a floor. Prices can't just drop to zero because the rental yield supports the value.
Precisely. It stabilizes the inventory. We aren't going to see a flood of desperate sales if people have this rental parachute.
But I have to ask, who are these renters? I mean, $2,300 a month is not cheap rent.
That is the great irony of the current market. To qualify for a $2,300 rental, you typically need to make 3x the rent in gross income. That's a household income of over $80,000 a year.
So these are people who could buy.
Oh, yeah. They have the income.
So why aren't they buying? Why are they paying someone else's mortgage?
I think it's fear and uncertainty. Maybe they're terrified of interest rates. Maybe they're listening to deep dives like this and hearing prices are down 9% and thinking, well, I'll wait until they're down 15%. They're parking in the rental market until they feel more confident.
They're sitting on the sidelines, accumulating cash, just waiting for the signal.
Exactly. Which brings us to the big so what section of this whole thing. If you're out there listening to this, maybe you're one of those renters, or maybe you're a seller staring at a for sale sign that hasn't moved. What is your strategy for 2026?
Let's start with the seller, because I feel like they are the ones feeling the most pain right now.
For sellers, I'm going to be blunt. The hard truth is that you cannot price your home like it is 2022 or even 2024. That 8.9% drop in the median price is real money. It is not theoretical.
And there's another stat here that just reinforces that reality check. The percent of original price received.
Yes, looking at the Denton County Market Watch report, that number is down to 93.1%.
93.1%. Let's do the math on that. If I list my house for $500,000, because that's what I think it's worth.
On average, you're closing at roughly $465,000. That's a $35,000 gap.
That hurts.
It hurts, but the pain is often self-inflicted. That 7% gap represents a failed strategy. It represents listing high, sitting on the market for 60 days, getting desperate, doing a price drop, looking stale, and then finally negotiating down at the closing table.
It sounds like a slow bleed.
It is. And it's avoidable. This is where the value of an agent like David Peet comes in. The report mentions his 10-plus years of experience. That means he has seen markets that go down, not just up.
Right.
You need a strategy to price ahead of the market.
Ahead of the market. What does that mean practically?
It's like hockey. You have to skate to where the puck is going, not where it's been. If prices are trending down 1% a month and you price based on a sale from 3 months ago, you're already overpriced.
You're chasing the market down.
You're chasing it down. You need to price where the market will be in 30 days.
Because the first offer is usually the best offer.
In a falling market, absolutely.
Yeah.
You want to capture the buyer's attention immediately. And let's not forget presentation. Inventory is up 10%. You have competition. Your house has to look better than the 4,000 other neighbors for sale.
So fix the fence, paint the door, stage the living room. All that stuff matters now.
Staging is non-negotiable now. In 2021, you could sell a house with dirty laundry on the floor. In 2026, if your house doesn't look like a magazine spread, the buyer just swipes to the next listing.
Okay, let's flip the coin. I'm the buyer. I'm that guy renting for $2,300 in Little Elm, complaining about prices. I see the 9% drop. Is this my moment, or am I catching a falling knife here?
It certainly looks like an opportunity. Prices are down nearly 9%. That's a discount we haven't seen in a very long time. But more importantly than the price, you have terms.
Explain that. What do you mean by terms?
You have almost 70 days on average to make a decision. You don't have to waive your inspection. You don't have to bridge an appraisal gap with cash. And that 93.1% List-to-sale ratio, that means sellers are negotiating.
So I can ask for things.
You can ask for everything. You can ask for repairs. But the biggest lever for buyers right now is concessions. You can ask the seller to pay for a 2-1 buy-down on your interest rate.
Which lowers your monthly payments significantly for the first 2 years. That's huge.
Exactly. It makes the home affordable now. That's a tool you simply could not use in a seller's market.
But I feel like there's a trap here, too, the wait-and-see trap. I hear people saying, well, if it dropped 9% this year, maybe it'll drop another 10% next year. I'll just wait for the bottom.
That is incredibly risky. Remember what we saw in the city of Denton sales? Volume is up.
Great.
Activity is increasing in the affordable price bands. That usually signals that the smart money is already stepping back in.
The investors are waking up.
Investors and savvy homeowners are seeing these prices and realizing the value is there. If you wait for the absolute bottom, you usually miss it because by the time the data confirms the bottom, prices are already on their way back up.
You don't want to be the person waiting on the sidelines while the game starts again.
And if interest rates drop even a little bit, all those renters we talk about, the ones paying $2,300 a month, they're going to flood back into the market. And suddenly, you're right back in a bidding war. You want to buy when it's lonely.
Buy when it's lonely. I like that. Before we wrap up, let's just broaden the scope for a minute. We've focused heavily on Denton, but are there any, weird outliers in this report?
There's always an outlier. I saw Clay County on the list.
Clay County, I saw that too. That number jumped off the page.
The median price in Clay County is up 77.1% to $296,500.
77%. Okay, everyone, pack your bags. We're moving to Clay County to get rich.
Hold your horses. Look at the volume. They had 8 closed sales.
8 total.
8 total. So one big ranch sale probably skewed the entire chart for the quarter.
That's hilarious, but that's a good point.
But it's an important lesson. Low-volume rural markets are incredibly volatile. That's why we focus on Denton County. With over 3,000 sales in a quarter, the data is statistically significant. It's a reliable trend, not a fluke. And the trend is a steady, healthy normalization.
Normalization. I like that word. It feels less scary than crash or correction. It just means we're getting back to a market that actually makes sense.
It's a market where math matters again. The pandemic premium is gone. The suburbs are settling into their long-term value trajectory.
So let's synthesize this for our listeners. If you had to sum up the Denton County shift in, say, 3 bullet points, the Blinkist version, what are they?
Number 1, Denton County is in a correction, characterized by an 8.9% price drop and significantly longer days on market. The seller's leverage is gone.
Gone.
Number 2, the volume is shifting toward affordability. Cities like Denton and Louisville are outperforming the more expensive areas because buyers are hunting for that sub-$400,000 price point.
Right.
And number 3, the rental market is the safety net.
Yeah.
High rents are keeping a floor under the market, preventing a total collapse in prices and offering sellers a plan B.
Clear, concise, and actionable. And that brings us back to the source of all this insight.
David Peet and Peet Realty. We've crunched a lot of numbers today, but as we just saw with the Clay County example versus Frisco, averages are great for deep dives like this, but they are terrible for pricing your specific home.
Real estate is hyper-local. Your neighborhood might be performing totally differently than the county stats.
Exactly. If you're considering selling now or even later in 2026, you cannot rely on Zillow estimates or what your neighbor told you they got for their house 2 years ago. You need a strategy. You need to know exactly where your micro-market is trending.
So here is the call to action. Go to peetrealty.com. That's P-E-E-T, realty.com. You can actually download these specific reports, the trends, the market watch summaries, and see all this data for yourself. But more importantly, call David Peet first. Don't wait until you've already made mistakes to bring in a pro.
Especially in a market where the list-to-sale ratio is 93%. That 7% gap can be closed with good strategy, or it can be lost with bad strategy.
Before we sign off, I want to leave everyone with a final provocative thought, something to chew on. We talked about rent being around, $2,100 to $2,300?
Yeah.
And we talked about home prices dropping to the low 400s or even high 300s in some areas.
I see where you're going with this.
At what point do those two lines cross? At what point does the falling purchase price and the rising or steady rent meet, making it mathematically cheaper to buy than to rent again?
That is the buy versus rent tipping point. With every single percentage point that prices drop, we get closer to that line. And when we cross it, when it is undeniably cheaper to own a home in Denton County than to rent one, that is when the next boom starts.
And we might not be there yet.
We aren't there yet, but we might be crossing that line sooner than you think.
And you probably want to be on the ownership side of the table before that happens, something to mull over as you finish your coffee. Stay curious, stay informed, and we'll catch you on the next Deep Dive.